We're starting session number 4 of this webinar series as people are rolling in, and we know some people will be listening later. Welcome, good afternoon to all. This is the fourth and last of our webinar series on impact measurement and management. And in a way, the most exciting part is obviously when you want to implement this, and then you hit the practicalities, and with that, the challenges, which is the big theme for today. We know that some of you pulled in at the previous sessions, and we slowly built it up. And today it's really about translating it to our daily practices. We, in the middle of the screen, show again Wendy Braken, impact expert at IFB, who's been preparing and coordinating all this. And our special guest today is Hugues Pirotte, professor at URB, very specialized in this space of impact financing. Hugues was one of the big helps on the big market study that we did a year and a half ago, right before we started IFB, and we're very happy that Hugues was available to contribute today. And my name, you see on the left, Frederick van den Bos. I am the CEO of IFB. We started early last year as a membership organization, and here you see the whole group, currently about 40 members, financiers in Belgium. Many of you know this, so I'll keep this very short. It's a slowly growing group, from very large to very small organizations, but all active on the funding side of the market, and all eager to improve and expand their activities in the impact finance space. As an organization, we do research and publications. We organize working groups where our members can meet. There are different events where we can share experiences. And one of the many activities is this webinar series that actually builds on a publication that was released last November with much demand in the market, to translate it into your daily business. What we'll do today is Wendy will kick off on the topic, and then after that it'll be Hugues contributing. And there will be time later for Q&A. At the bottom of this page, you see my email address that can be used for questions. The chat can also be used. We noticed in previous rounds that people like to use both channels. So Frederick at Impact Finance is the way to reach me. I'll keep an eye on the mailbox, and I'll keep an eye on the chat. And with that, I'll pass it on to Wendy.
Good day, everybody. So if you talk about impact measurement and management, most of the time you hear the challenges about how do you define intentionality and additionality. And that are two topics that we will discuss deeper today. But before going deeper to those challenges, I want to highlight also two other challenges that are related to the definitions and to the approaches applied. In fact, if you look at the GIIN definition, so the GIIN standing for the Global Network of Impact Investors, who are who steer, in fact, the impact investors scene, they define impact investing as investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. So in the definition, they focus on intentionality and measurability. But if you look to the 4 principles that GIIN put forward, then suddenly there also appear additionality. So additionality is not part of the definition, but is part of the principles. And there's already one of the challenges or one of the discussions among impact investors. Do we need to have to consider additionality or not? Because it's not clearly defined in the definition. Another aspect related to the definition or to the approach is the fact that the GIIN, they come from another, they approached impact investing from another angle than the European Commission. In fact, you have the GIIN, who is the worldwide network situated in the United States, and they talk more about impact investing as a philosophy. Well, if you go to the SFDR, so the European regulation adopted by the European Commission, standing for the Sustainable Finance Disclosure Regulation, it gives directives to investors how they have to implement minimum criteria, standards, in order that they can talk about sustainable finance and how they can call their products. So you hear already two approaches. You have the SFDR, who's really looking about minimum standards and criteria on disclosure, while impact investing, well, the GIIN is more looking like the philosophy and the general approach. And both have to be combined in the future. In the SFDR, till so far, impact investing is not addressed, but in the future it will, and it will be a challenge to see how both approaches will come together in that regulation. So there's already two challenges. They're not related directly to intentionality and additionality, but it's also good to keep them in mind because they play also in the background. If we again go to intentionality, one of the first of the third challenge, so the third challenge. So intentionality is does mean that you look at the intentional desire. It stands for intentional desire to contribute to measurable environmental solutions for problems and address opportunities. So there is an intention that you have to formulate. The difficulty with intentionality is that it's not always clear how well defined has that intention has to be. Is finance for good an intention? Yes, it is, but can it be accepted as an intentionality within impact investing? That it isn't. Because what GIIN proposed or what put forward is that there is a clear link between your investment activities and your realized impact. So if you provide capital or non-financial, or do you provide non-financial support by coaching or by training, then you really need to have that, make that link between what you're doing and what the impact is realized through the investees. How you can do this? There are a lot of methods to do it. You can formulate impact objectives. You can formulate a theory of change. That's really a visual connection, how you combine inputs, activities to results, and the effects that you realize in the society. That is a visual presentation that is also often applied, and we explained that in the previous session, so I'm not going to deep dive again to that. Then I just invite you to look at the previous webinar, the registration of the previous webinar, where we explained it a little bit more. Impact objectives and theory of change are normally what I also want to highlight is that defining your intention goes further than just defining some KPIs, so key performance indicators. Because if you say, I just want to reduce a certain amount of the CO2 within my portfolio, and you cannot link it with your investment activities, then that's a KPI, but that is not an intention. The intention is really, I do this because I really want to obtain that added value with my investee. And if that's not clear, that link is not clear, then it's not considered as intentionality, according to the criteria or according to the criteria of the GIIN. So that's about intentionality. Then you have the second topic, that is additionality. And intentionality, as you see, there's also always related to additionality, because with your intention, you want to create something additional. And there sometimes is already the confusion, how both are linked. And however, you have to separate them. But here I discussed it separately. And additionality is in fact the contribution to the growth of the industry. It's a very broad term, and because it's very broad, you can also have different interpretations. In general, if we discuss about additionality with impact investors, then you see that two levels of additionality are considered: the level of the investor and the level of the investee. If you look at the level of the investor, and that's the next slide. Yeah, okay. Then you can have different types of additionality that you can provide. You can have non-financial additionality, financial additionality, or no investor additionality. Non-financial additionality is in fact an active engagement that you take as impact investor to your investee. And that can be different on different ways, that you provide coaching or that you provide support so that that investees can develop better their business model, or that they can develop practices of impact measurement and management, or that they clear view on their focus. Can be of different kind of engagement that you as impact investors take to help your investee to create more impact. Another additionality that you can create, and that's often applied, is a financial additionality. And here is a focus that you accept a higher risk or a lower return, or that you provide patient, flexible or concessionary capital, so that you provide other kind of capital that is in general at the market. Sometimes there's no investor additionality. Some investors, they just say, okay, we put money at disposal for a certain solution in the society, and that is our contribution, and we don't create additional impact. Or sometimes the impact can also be that an investor already invests in a certain company or a certain investee, and that gives the possibility that other investors who only can apply in a second degree that they can come in. So that can be sometimes also their additionality, but then it's considered as no investor additionality because they don't do anything for the investees. Now, how it's applied, it depends a lot of the impact investors. If you see a lot of impact investors who are investing in private equity, they will apply a combination of non-financial additionality with financial additionality. If you look at banks who also want to invest, who has also a part that they want to invest in impact, then often they apply the no additionality because they provide more the means, the financial means to address those problems. So it depends a little bit who are you as impact investors, how you apply additionality in your practices. That's at the level of the investor. Then you also have the level of the investee. And that's the next slide. An investee level is what is your additionality? That's in fact, that is the strategy that you apply to address underserved problems and underserved populations. How you can assess it the best way, it's with the IBC framework that we also mentioned before. And IBC stands for avoiding harm, B, benefit stakeholders, and C, contribute to solutions. In fact, in the category A, we're really looking at to reduce your negative impact. While at B, you're looking already a little bit wider, then you also look at the negative impact that you create in your value chain. But C is really a specific categorization. We really look at how they can contribute to address the problems, the underserved problems or underserved populations. So that's another way to assess additionality at the level of investees. So that's a broad introduction about the challenges, intentionality and additionality, but I invite Hugues to complement because he has still a lot of reflections on it that can be very useful also for you.
Yeah, thank you, Wendy. Thank you for inviting me to your webinar. Maybe we can show the next slide. Yeah, so thank you for inviting me. It's quite a topic, of course, and today we concentrate indeed on intentionality and additionality, but I wanted to first give back some words of context which link to what you just said, by the way. First of all, well, here we are in impact investing. We can have impact in very different ways, but this is really about impact investing. And when you see a quite recent study from the GIIN, you still have, I would say, under their study, they studied, I would say, more than 116 funds and managers, investors, investees, and what they return is that 74% of the investors are really looking towards market risk adjusted return. So they want to, in fact, have a positive societal impact, but still acting under the same, I would say, financial standards. What is interesting also, and which will be mentioned later on, again, by some authors that I researched, is that one thing is about, of course, trying to mitigate risks. And typically for those investors, for the majority of the market, the number one risk is, in fact, the capacity to execute the business model, its integration and the management. But still, even though they look at this, they will look at multidimensional standards when they consider making an investment. So it's really, I would say, a very thorough process where qualitative and quantitative dimensions are examined. I think you made the point comparing GIIN to also the European, I would say, landscape, GIIN coming from the US side. And I think it's important to notice that we have different driving forces. We have on one side a market practice. So GIIN represents a little bit the philosophy of the market practice, what we do consider as being impact investing, but more from a philosophical target and way to go from the practice. And it's quite principle based. When we go more to regulation, which is more about disclosure, which is important as well, because of course the target here is to try to attract more traditional investors to join social investors. And of course, there we come up with a framework that can, I would say, reassure people, that investors, that from these big institutionals, that they are really, considering investing in impact investing, which is according to some standards which are recognized and where there's there's less risk, in fact, not to be in an impact investing world. But then we are much more in a rule-based framework where adjectives, how you support it, is very important. While on the market practice side, we are more on the principles and, how far can you really support that what you are doing is contributing or directly being involved in impact stories. I would just conclude that on this slide that is a very nice article from Hawkards and al. So a series of 4 professors in the Journal of Business Ethics 22. I really encourage everyone to read this paper. It's well written. It really summarizes a lot of what has been researched in terms of evolution since 2013, 7 and 13. And they talk about 6 dimensions where obviously you have intentionality, additionality. Then they compare contribution, attribution, and then we have the materiality and measurability, of course. So we are going to focus on the first 2. And it's sometimes very difficult to talk about each of them separately because they are intertwined in when we talk about them. So maybe we can go to the next slide. So I was trying to retrace a little bit. There's a lot of text, but I will, of course, summarizing with my oral presentation. If we retrace a little bit the evolution, even the United Nations Commission for Environment and Development, in the agenda of '94, there was already, I would say, a debate on the controversy over additionality. If we take that historical way to go, it was more about the financial additionality. It was not really about the development. It was much more about how the North can contribute to the South with new means of financing and not the traditional ones, which we know. So it was more in that direction, but they were still talking a lot about how can you consider financial additionality. There's a very nice, I would say, common playing ground paper that is well cited by Bressenborn in 2013, people from Stanford, with some controversy. So indeed, some debates. It was maybe the first time where we were just coming with the words enterprise impact, investment impact, and non-monetary impact. So to summarize it, well, we could say the investee perspective, the investor's perspective, and then the enabler's perspective, typically like the IFB, it's an enabler in this sense. And of course, the definition is that we have to be able to show that if we believe in additionality, we have to try to show that the quantity or quality of the social outcome is beyond what would have otherwise occurred. And since then, of course, there was a kind of debate about, okay, we are supposed, so they were talking about finding counterfactuals. So can really find counterfactors, what would have happened if we wouldn't have had social investors or societal investors in the first place. The debate in the paper is that, of course, some people were criticizing afterwards that the fact that they were still focusing a lot on if you are going to look at market returns through, I would say, normal public markets, you would, by definition, have a very difficult to prove impact, and that therefore it's much more about investing in domains which are not large public markets, but more in smaller private markets where the benefit, the financial benefit can come because you exploit some frictions or imperfections. And those imperfections are very wide, but typically, for example, if you are a societal investor, one of the frictions you see in public markets is that traditional investment wouldn't consider domains or investees where there's a lot of skepticism. And typically you exploit somewhere the skepticism about some new research, some new developments having really an environmental impact, for example. And then that's where you try to have in the long run some benefit. And this is, of course, a little bit subject to debate because we know that if we want to really have a major impact in some domains, we cannot just, I would say, focus on smaller private markets only. We have to have a scaling. We have to be able to have a scaling of those solutions which are potentially found. Nice point of this common playing ground mentioned by by Briston-Born, sorry, is the fact that they bring also this notion about you have enablers, and therefore impact investing capaciously is also actively placing capital in enterprises that generate a societal impact in terms of services, goods, or other potential connected benefits, like a better environment for the job. And they come up with this notion on non-monetary impact. So if you can go to the next slide. And this is non-monetary impact is, in fact, looking at all the enabling community. And in particular, one which is quite interesting is trying to gain socially neutral investors, like they call them. So trying to gain investors which are investing, I would say, in a traditional way, to try to have a blended capital, attracting those socially neutral investors, like they call them, to be able to scale up the projects. Can we go to the next page? So additionality. Beyond that base of 2013, we have some developments, and I just mentioned them here one by one. In 2021, so it's quite recent, we start to have authors, researchers, the community which tries to come up with how can we categorize the additionality and the intention? How can we categorize that? And the proposal of Bush and other authors is to come up with impact aligned versus impact generating investments. So investments that try to align the targets, the intentions, and in fact, investments which are really closer to the ultimate objective on the ground to generate really a new impact. It's a different way to see the value chain and impact between investor and investee, which can be quite a lengthy way. The paper of Winkler-Anderson about blended finance is very interesting as well, because, well, they come up with the idea that like measurability, you have to be able to check it, to have an idea ex ante, to prove that there's an intention behind the additionality, if I can say that, but also to try to check it ex post as well, that there was an additionality. And again, they come up with this idea of categorizing financial versus development additionality. So financial providers and development investees in this case. And they talk about the notion of causality, of course, which Wendy mentioned a little bit, which is, can you then prove that what has been generated is linked to, of course, the original investment and intention. The paper of Hockerts is interesting because when they talk about it, they try to refine one important idea. They try to refine the fact that it's very difficult to talk about additionality and intentionality as well, because they talk about the different dimensions without really specifying what is the role of the person or the entity you are talking about. So they try to separate this between portfolio companies, fund managers, and investors. And they try to see at the different levels, how could you qualify the additionality? One thing which is very important is the last one for investors is, are you sure that you are not really merely replacing traditional investors. And it sounds like a little bit, yeah, at the beginning, we are all positive about the fact that we bring additional investors which are more socially involved. But for example, there's a study mentioned by this paper about from Patrick Reichert, IMD, and Marie Cudon, a colleague of mine, which show that constant soft terms by idealist impact investors may scare away commercial investors if economic viability is not demonstrated. And this is very important because the idea is to come up as an additional source and not as a replacement source, pushing away other types of investors. So the type of investors which are involved and the categorization of the type of investors is quite important. And I will try to show you some tables to give you an idea of what could it be. Something which is very important is that they are one of the main criticizers of the counterfactual. They say, well, you know, counterfactuals are probably unprovable, except in some particular cases, like, no, can you come back, please? Like the GHG, the GHG, the gas emissions, the greenhouse gas emissions. And they show that, for example, there have been strange phenomena where to be able to prove it's a domain where it's quite easy to prove the counterfactual compared to other domains, where, for example, you would show how much you are capable to avoid in terms of emissions if you wouldn't have been doing this. So the counterfactual is do nothing. But there's a nice study that shows, which is reported by Hockerts, which is a nice study that shows that in some cases, we have been able to prove that in order to be able to show that we had reductions in gas waste productions, actually, the source of emissions were increased in some way. So there was a kind of deviance, completely perverse behavior, where you would continue on the ground increasing the number of sources of gas emissions to then be able to say, look, I was able to reduce them afterwards. It sounds quite a pity, but it was clear in a big, I would say, greenwashing case. So now we can go to the next one. And this is, by the way, a study which I showed Thomson 22 because typically they talk a lot about this. It's quite the counterfactual in biodiversity, gas emissions is something which we can easily, I would say, conceptualize. And it's interesting because they look at counterfactuals and be able to establish additionality like a risk mitigation strategy. They say, well, if you want to protect your investors from the risk of reputation, of in fact performing investments which are mostly greener as greenwashing and not really on purpose with a clear additionality, you really have to include in your risk monitoring what kind of baselines do you use, what are the counterfactuals, etc. So and also, of course, guarantees about the financial part. But it's very important, of course, they look at this in the context of investing through bonds and in a context where counterfactuals can be imagined. But of course, on making sure that you have non-perverse baselines where, in fact, the underground situation would continue growing and you could prove that you are reducing, but you are reducing something which is actually growing on the trend. Nice study by the NBR in 23 by Cole and other authors, but this is a study on average. It's clear that the risk profile of impact investors is one more on the long run. It's investors which exhibit more risk tolerance and patience, and looking at disadvantaged areas or nascent industries. For example, soil redeployment would be part of disadvantaged areas, for example, or areas where, for example, contributing to the development of new medical devices, which can be cheaply produced for the South. That would be typically a way to also prove additionality through the contribution to an area where there's actually no interest at all in providing a solution from the traditional finance. Still, it's interesting that those authors, on average, again, I mentioned because it's important, it doesn't mean that it doesn't happen, but on average, the big average of impact investing doesn't seem much to expand yet the financing frontier, in the sense that they still, in the big cases, co-invest with traditional investors and not really in grounds where they would be really purely alone in that case. An interesting thesis from a student, by the way, Pearson in 23, so quite recent, who was looking at public markets to say, can we really consider still in public markets? He was showing that it could be feasible, but not without shareholder activism. So it's not just investing passively in the public markets, it's really investing with a willingness to control and to change the scope. Typically, you would invest massively as a big foundation, you would invest massively into, I would say, an old industry kind of company to try to be on the board and to change the way the business is behaving, to push the business to adopt new strategies and change its attitude. Can we go to the next slide, please? Internationality. Of course, internationality is something you have to support. So proving is a little bit a strange word, unless you can show expose that it was the case. But ex ante, you have to be able to show that you have clear expectations, that you proactively are putting, at work some means to be able to pursue the objective or check or monitor the objective. This study, what's in a name, it's interesting because since we talk about regulation, about disclosure, what's in a name is important. And Hochstetler and Scheck in 2015 already tried to look at all the language being exchanged by fund managers, by investees, by investors of many types. And these are the words which come back quite frequently, which is how do you design the investment? How do you mandate the investees? This is very important. As you will see in the next slide afterwards, contractualization seems to be different. And this is what a study of Wharton and Booth showed in 2018, that if you compare the contractualization of traditional investments with that of impact investing, those contracts tend to be more going to the detail of the operationalization, into the governance and compensation elements, and also, as you can see in red, in different forms of complementary roles. So they go really beyond the investment itself to try to tackle really what are the kind of roles, attitudes, and philosophy that we expect from the investee given the investment we make. So contractualization tends to be really the time of terms you use, the time of governance you use, could be really a ground of proof that there was really an internationality, of course, in this case. The very recent study, to come to an end to the discussion, Heinz and Velamuri in 24, that's quite interesting, very, very recent. And they tried to come up with a way to look at the type, again, come back on the type of investment and to see if the motivations and the way they were deciding on investing was really different. And what they see, which is quite interesting, is that you have the true, really strict impact investors, and then you have investors which are more on the borderline with SRI, with sustainability, with impact. And they see really key differences and the way they decide and they try to check and monitor their investments. So I think if you want to look at concrete arguments which are being exchanged and which are being identified, this is really a paper you can find very easily on the web, and which is really nice to read and easy to follow. Can we go to the next one, please? Yeah, and so this is a little bit what, for example, Hawkers is showing, Hawkers and all in 22. This is there are different tables. Of course, they are sometimes very big, so I encourage you to look at the papers back, which are, that's why I put the whole title and the references, so you can easily find them back for your own reading. But typically, this is a typical table where you would look at, on one side, what do the investors intend to do? And on the other side, what the portfolio companies, which in fact combine the potential investments for the investors, are looking at as well. And it's interesting that depending on the situation, you can have very different types of investors. And typically we were talking about idealist investors, which were in some cases deterring the presence of more rational investors. And this is the kind of, I would say, categorization that they would come up with. And so obviously the center is the most desirable type, going from types which are trying to screen whatever frictions they can benefit from, to, I would say, greenwashers who try to claim that they found a new nirvana in some way. But in the middle, we have those rational investors who tend to still look at the financial performance in a viable way, because this is not about philanthropy, it's about impact investing. But at the same time, making sure that they follow the philosophy that they were putting forward, notably with the contractualization they were using. So the real objective behind is very important, and would define different types of governance also in those funds. For example, if you mix rational investors with idealist investors, you would typically tend to have different types of frictions than if you would have a more homogeneous type. And this is just one example. Next slide, please. Yeah, and so to finish my presentation, I was allowed by Wendy and Frederick, thank you for that, to mention that where I'm teaching and researching, which is the Solvay Business School at ULB, we are actually inaugurating the Solvay Impact Institute, which purpose is to really build on the business engineers, students who combine management and understanding of sciences in general, who can play a multidisciplinary, I would say, role, partnering with other types of disciplines in other faculties, and to really provide a new way, a new, I would say, approach to education and applied research, where we would be much more focusing on projects around education, bringing, I would say, proposals from the impact world, making sure to be enablers of contacts between the impact world, the students and the researchers, I repeat, applied research, and of course, make these young people become actors of change. Actually, we provide these students with a degree, and we tell them, okay, now you have a degree, go and change the world. Well, we would like to make sure that they are actors of change together with the professors during their studies, which would be much more motivating for the whole community. That is what I have to say, Wendy.
Wonderful. Thank you, Hugues, for your elaborate expose. I'm happy about the last page because that shows how also business schools see the potential of the topic. that's growing in many fields. Thank you very much. It's very nice to see how you refer also to different studies that were done by academics across the globe, and that combined information is I think very useful. I had a few questions actually myself, but also a few that came in. But I wanted to start. Hugues, your one before last page on the intentionality, I was surprised you say like the desired outcome is of course in the middle, the rational investments, whereas I had expected you to say it would be the arbitrage investments because that's outperform and outperform, so double outperform.
Oh yeah, I was maybe a bit quick saying desired. I would say that it depends how you reflect. Obviously, there's a strong believers that in some cases you can really have outperformance in the long run, by the way, but much more because of an amplifying phenomena. So I have a very good case in mind. That's the example of cacao trace, typically, where you can show today that there's an amplifying factor, the fact that in the value chain, you reinvest in the chain with the farmers, give you a supremely high fidelity of the farmers. An education on new methods is possible if you have this connection with the farmers. Is also you give them back a retribution of the margin you generate. You have a better quality of cocoa. And on top of that, in a context like today, where you have floodings, drought, etc., repeatedly, where you have today a scarcity of 1/5 of the total volume necessary on the market. Those who have been investing as impact investors almost 10 years ago are now seeing the real true impact of this amplifying phenomena. So would you call it a friction? Yeah, there was a friction in the sense that nobody wanted to do that before. The idea was to extract return. And yes, in that case, you could say it's an arbitrage. Yeah, it's an arbitrage that you can see today, 10 years after. It was an arbitrage because we were able to be there where nobody wanted to be, doing what nobody wanted to do because we were focusing only on the short-term return performance. But still, those people who are happy today had a long road to go, convincing shareholders that this was the way to go. And today, they see the impact and they are happy to show that this will be, of course, this will be a way to convince investors that this is really the way to go. So if you call it arbitrage, yeah, exposed, but in this case, not necessarily ex ante. And so that's why, yeah, the pretension ex ante, it's sometimes difficult to prove ex ante.
Yeah. And that particular example is very sensitive to market swings with cocoa prices more than quadrupling over the last few years. Not always.
Yeah, and of course, if you produce cocoa of a high quality, you can justify more easily those high prices. By the way, the farmers understand that cocoa of a better quality would typically be payable in some sense, and therefore they have a future. But those who have facing much stronger costs and problems, and on top of that, they have to sell a more standard regular cocoa, which was not enhanced through better cultures, etc. Today will suffer a lot. So
yeah. This maybe goes back to your very first slide. You showed the 74% of impact investors or investors interested in impact that we would typically qualify as finance first. They do want to have their proper return or risk-related return, and then in addition have impact. This is also ex ante. So I wondered if
no, but it was not really finance first. It was first in societal impact, but not seeing this as a trade-off with respect to a financial return.
Okay.
And of course, this is part of the debate. But the debate is it's like any study in asset management, short-term, medium-term, long-term. If typically these are more patient and tolerant investors about risk in the short term, but in the long run, you can show that you can even have a very strong performance exposed if you would be believing this about what you do, and you could scale it up. You can have potentially a nice financial return. But this is important because, as you could see in my slides, if you say impact investing is about a lot of different people and we put them in the same basket, you have the risk that you're never talking the right language for the right type of investors. And so you have investors which, as Ockler shows, that are more of the idealist type. Sorry for the adjective, but versus investors which are really still saying, no, I don't see impact as a trade-off between leaving money on the table or having an impact. If you put these two types together and you don't really address the two languages, depending on the type of investor you have, you might have a problem of one size fits all, which doesn't really correspond to any of them. And then you would have less enabling impact yourself.
No, I totally agree. And you see lots of different investors along the spectrum with different targets, as in return expectations, financial return versus the non-financial return. I could pose different questions in that field. I did have a question here about trade-offs, and you didn't really mention it, but maybe that's why the question was posed. If we talk about impact, we always think, oh, it's something positive. But how to deal with trade-offs in the types of impact you realize, and the classic trade-off is between environmental and social, where sometimes an investment can be done with good environmental impacts, where the social impact is less positive, or the opposite. You make investments that help people find jobs and further, especially in developing countries, to get better lives, but at the detriment of something environmental, whether it's CO2 or something else. Have you come across these as well in your work?
Yeah, mostly interviewing fund managers or investees on some particular stories. Of course, some are easier than others in order to show this, I would say, a good balance. I would say that, as everything, if you are focusing too much only on one of on E, on S, or on G, for example, if you focus too much on one at the detriment of the other one, in the long run, this would hit back. So it's quite important. Of course, you tend to have a concentration on one of them, but it should be without, I would say, forgetting the existence of the other ones. Typically, in the cacao trace is a good example where it's E and S. I have another example I know from one of your members, by the way, who is about good governance even in small local banks. Well, this is about E and S as well, because it's governance, but it's governance in the sense that these banks is locally aware of the E and G and S that those banks are, the clients, the borrowers are facing locally. And so they try to help those borrowers on the E side and the S side, but the E in that case contributes to the S to try to make sure the local borrowers are identifying or using new cultures which are more resistant to drought and to diversify their crops, etc. So in this case, this bank is looking at the G of governance, good governance in terms of allocating loans, but working behind the scene with the borrowers directly on their E exposure.
Okay.
So there are ways to find not necessarily a trade-off. Of course, there's a focus, but I would say that we have more and more stories where you don't necessarily have a trade-off, and it could be possible. Now, there's one thing which is important. It's the trade-off from the stories I'm telling you. The trade-off has been, when we talk about finance, we tend to say there are three dimensions about the financial aspect: is risk, return, and time. And time tends to be So the risk you're facing is that you have to try to convince your investors for a longer time to wait and see.
Yeah.
Which is not necessarily the case for traditional investors. Not an easy case.
Yeah.
We know many cases where somebody was refusing to invest in something, and because of the pressure of the portfolio managers, at the end they accepted to do it. And after the fact, we discovered that the person was right, but this person was under extreme pressure to lower the constraints. So I would say that, the people who today see the impact of the good news is that we have more and more examples, but those pioneers had a hard time about convincing year after year that they should continue doing that.
Yeah. I was waiting for the word liquidity. It often comes in then as well. Even if all goes to plan, there are enough examples where the liquidity needs a few years to be built up.
But liquidity is intimately linked to time. So obviously. Yeah.
Okay. Another one, but maybe that's more for Wendy. Some of the terminology used is very open to interpretation. And earlier on, the ABC came in again, contribute to solutions. What is the solution? What is contribute, as opposed to benefit stakeholders? Who are the stakeholders? What can be called a benefit? Somebody writes here, like, is IFB helping on this, how to translate it, these principles to their members' practices?
I think we can also confirm it, because we were really looking at how we can define some concepts and how we can make it more clearer based on practices and based on also the regulation that's going on, because like we said before, you have the combination of both. And there is still a lot of things to clarify more. As we know, additionality, intentionality. So we tried already to give you the bigger frameworks so that you have already the bigger ideas. And within those existing frameworks, we try to define, okay, what does it mean concrete for every investor? And sometimes you see, like Hugues also said, there are other investors who interpret it differently because they have another type of investors than others. And sometimes you have to translate it to the different types of investors too. But that's where that we are doing currently with our members and with academics who are more have also a lot of experience in it. So
I suspect this question has a background with the ESMA guidelines, but I'm not sure.
Just one comment. Almost all of the papers I was showing you are papers of, yes, it's academics, but these people, almost all of them have been interviewing, in fact, what happens on the ground. So these are empirical papers, interviewing what fund managers, portfolio managers, investors, investees do, why, when, what are the phenomena, and it's trying to find the codification of language throughout all these experiences. With still the idea that people who are really on the practical side, on the practice side, think that it's more a philosophical standard that you impose to yourself. And you have the first people who have to believe it is yourself. The problem is that if we want to attract those institutionals to invest 1% of their wealth into impact to grow, then we have to provide a ground of satisfaction in terms of not being exposed to reputational risk if we say we invest in impact and it happens it was not later on, because those mass investors would be, I would say, more keen to be sure that they are on a framework that they can obey and follow, and under safe guidelines. And this is why we discuss about that at the moment.
You call it the legalistic approach, I think, earlier. Yeah. Which is very understandable, especially for larger financiers. Well, I guess for all financiers, but especially for large financiers who manage funding for others. And that's where SFDR and the ESMA guidelines really come in.
I still believe that even though of course, it depends how far you are in the value chain. The closer you are to the investee, the more is about attribution of what you create. the more the further you are from it is more contributing to it from a further approach. And institutionals are probably quite far at the beginning from being close to the investee. But I think that even though you believe that you can check all the boxes because of disclosure requirements, I still strongly believe that you have to philosophically yourself believe about what you do, because otherwise, even if you can check the boxes that we would have after debating all together about what kind of right rules we can impose to define this and that, I think that you cannot deter completely the perception of the market. And if the perception of the market is what you do is greenwashing, even though it is not, you will have a hard time in the short run. So you might have swings in what you do. You can be impacted by the market just because there is a bad perception about what you do. So I think this is not a 100% guarantee. It's not because you obey to a framework that you really can guarantee that what you do is impact investing, unless you truly believe about it. And the philosophy behind is that what you do is really towards a societal impact.
Yeah. Have you, on that note, seen any activity more on the audit side? So after reporting, and obviously financials get audited, the impact side sometimes by private initiatives, and it's a growing number. Have you seen trends in there of that aspect of the basic verification increasing?
Well, I see a lot going on with audit and controlling in terms of CSRD, of course. That you see a huge amount of, I would say, work being performed there. In the case of impact, I would be very careful personally about one thing is you have to allow still bad luck. Because when you invest traditionally, you have risk, and risk can mean bad luck. It's not because something doesn't happen that it was you not being on purpose doing what you pretend to do. It could be just bad luck. So I think that we have to be very careful about the ex post measurement. That's why I think intentionality is super important. You can prove that there was really a true intention behind. Because if you would tell potential investors that if they would like to go for impact investing, they would have to be 10 times more secure about this really going to provide a nice outcome at the end. Well, you are just putting conditions which are n times much more stringent than for actually traditional investment. So you will never start in the first place. So we have to be careful not to deter interest from impact investing neither.
Yeah. We're slowly coming to a close.
By the way, this is what is deterring a little bit the institutionals to invest. They're too afraid, super afraid that they could still be targeted as not really doing what they intend to do. So if people would, because they are more in a sense of measuring expos, that this was actually providing a result.
Yeah, but the expos will help to share the good examples, and they're ever increasing. I like different remarks you made about how you have to believe in this, whatever the rules and the regulations, you have to believe in doing this. And yes, you have to allow for bad luck, but that's a harder selling point with most of the financiers. I may totally agree, but we have to be careful about using that. It's rapidly evolving. You were referring to CSRD, SFDR was mentioned earlier, and I'm sure in the next 12 to 24 months we'll see quite some movement in this space, where we'll be learning together, and we'll keep informing each other. I want to thank you both very much for today. Thank you to the people listening now and people listening later.
Thank you.
This was the end of a series of 4 that concludes this webinar series. We, IFB, go on with many other items after summer. The first thing we do, but that's, I have to say, for members only, is an inspiration session on the theory of change, where we have a few members present and other members learn, because there's a crucial link between intentionality and the theory of change, and other aspects are on our list, including impact committees in the decision-making process. So we continue in different ways to ensure that our members can share good examples and learn from each other. Please check our website, where also this can be learned back, and where you can also register for our newsletter. I see, Hugues, you're eager to take the last word.
Of course. No, I thank you for inviting me, and thank you for all the listeners. I hope we can continue exchanging on these nice topics, and don't hesitate to look at literature, because there are nice things to read.
And the Solvay Impact Institute. Thanks again, Hugues, and thank you, Wendy. Thanks, Raoul. Have a good day.
Bye-bye.